The conversation almost always centers on physical barriers and the geography of the border. Because we conceptualize the drugs moving physically, we picture the profits moving the same way, bundled into duffel bags and smuggled south in the trunks of cars. This is the bulk cash myth. But the scale of modern cartel revenue has outgrown physical transport. The U.S. government recently flagged $312 billion in suspected money laundering transactions tied directly to these networks. We read the research so you don't have to. Today, we are examining how the modern drug trade functions as a global liquidity network. The vast majority of cartel profits never actually cross the sovereign borders of the United States or Mexico. By treating cartels as localized criminal gangs rather than multinational holding companies, global law enforcement is fighting a 21st century economic war using 20th century geographic tactics. For decades, the cartel business model was constrained by agriculture. Traditional drugs like cocaine and heroin are tethered to rigid bottlenecks: weather patterns, crop cycles, and physical land eradication. The strategic pivot to synthetic drugs like fentanyl and methamphetamine decoupled the cartels from agricultural vulnerability. The manufacturing economics of synthetics rely on raw precursor chemicals, sourced largely from China and India, and basic lab equipment. This allows for near-infinite scalability. Traffickers employ adulteration strategies, mixing inputs like xylazine with fentanyl. This practice artificially stretches the raw materials and standardizes the dosage forms for mass distribution. Synthetics transformed cartels from agricultural smugglers into global chemical logistics firms, matching product diversity to the precise demands of international markets. Two primary players dominate the synthetic economy: the Sinaloa Cartel and the Jalisco New Generation Cartel, or CJNG. Sinaloa operates as a durable, decentralized federation. Semi-autonomous factions specialize in different logistical steps: procurement, wholesale distribution, while sharing transportation corridors and brokerage services. CJNG utilizes a contrasting approach, a rigid, top-down franchise business model, overseen by a small group of top-tier commanders. This franchise model is designed to scale aggressively. Leadership demands strict branding and structural compliance, and in return, they collect a percentage of all local franchise profits without paying the operating costs. To secure the logistics network for this franchise, CJNG uses targeted violence to seize strategic logistical choke points, such as major highways and border plazas. With these corporate structures in place, illegal drugs are no longer their sole revenue stream. Cartels have diversified into huachicol, or fuel theft. Operatives siphon crude oil from Mexico's state-owned energy company, Pemex, using illegal pipeline taps and coerced employees. This stolen crude is smuggled into the United States, deliberately mislabeled as waste oil, and sold at a discount to complicit energy importers. The profits are then repatriated to Mexico. Sinaloa and CJNG operate today as highly diversified transnational holding companies, managing complex operational portfolios. These holding companies face a critical logistical hurdle. They generate massive amounts of U.S. street cash, but they need clean, usable pesos in Mexico to fund their ongoing operations. Simultaneously, wealthy Chinese elites want to move their wealth out of China to invest abroad, but they are strictly blocked by Beijing's $50,000 capital flight limit. Chinese underground banking systems bridge these two disparate needs by acting as a shadow broker between the cartels and the investors. The process begins when a cartel operative deposits illicit bulk cash with a Chinese money broker stationed inside the United States. The broker immediately unlocks equivalent funds they already control in Mexico, paying the cartel's associates in clean pesos. To settle the balance, the Chinese elite pays the equivalent amount in Chinese yuan, receiving the US dollars in America. This diagram from the DEA shows exactly how this works. It outlines the cyclical relationship between Mexican cartels and Chinese underground banking systems, which law enforcement recognizes as the primary money laundering mechanism for modern cartels. This is the mirror exchange. Tremendous financial value transfers across the globe, but the actual fiat currency never physically or digitally crosses a sovereign border. This map shows where a Sinaloa cartel-affiliated money laundering network executed cryptocurrency transactions. Cryptocurrency allows brokers to convert cartel cash into Bitcoin at U.S. exchanges and transfer it globally in seconds, supercharging the shadow ledger. When brokers need to physically move value out of China to balance the accounts, they turn to trade-based money laundering. This relies on price mismatches and over-invoicing. A broker uses Chinese yuan to buy cheap export goods in mainland China, then ships those goods to cartel affiliates in Latin America to be sold for local currency. These valuations are entirely artificial. Investigators uncovered imports like Pakistan-made dish towels shipped to the United States and invoiced at over $150 apiece to hide illicit value transfers. Whether through instantaneous blockchain ledgers or overpriced dish towels, the global supply chain has been weaponized into a high-speed money laundering apparatus. To understand the physical cost of this financial engineering, economists use Mancur-Olson's theory of stationary versus roving bandits. When cartels act as stationary bandits, meaning they monopolize an area for long-term trafficking, they often minimize local extortion to protect their own logistical infrastructure and encourage investment. This map illustrates the contested areas of operation for Sinaloa and CJNG across Mexico. In these overlapping zones, fragmented cartels act as roving bandits. They engage in turf wars, utilizing kidnapping, extortion, and short-term wealth extraction to fund immediate conflict. Researchers can measure the exact economic devastation of these turf wars by tracking municipal electricity consumption. When a conflict triggers, local energy use sees a dramatic immediate drop. At the local level, cartel warfare acts as a severe economic depressant, forcibly extracting wealth from legitimate businesses and crippling regional productivity. Once laundered through Chinese brokers, this extracted wealth flows into the legitimate North American economy, inflating real estate markets and crowding out legal businesses. The cartels did not achieve their current dominance through traditional military insurgency. They achieved it by mastering global liquidity. As long as authorities fixate on intercepting physical contraband at geographic borders, this shadow financial engine will continue to run uninhibited. When a multi-billion-dollar empire operates through borderless digital liquidity, a physical wall creates an illusion of security.